Let's take the discussion forward with Feroze Azeez, who's joining us from Anand Rathi. Well, Feroze, afternoon. Thank you so much for your time. What would you attribute the sudden surge in the market? What trigger is it? We are almost at 22,850, heading to 23,000, it appears. But what are the triggers in your view which are playing out?
I think if you look at how the market has been positioned, I think one lead indicator of where the markets could get a squeeze from is the FII long and short ratio. Okay, the shorts have been upwards of 65%, whereas FII long positions have been 35. This is index futures, which I'm talking about. When you look at this as a lead indicator, anytime when there's a move, short squeeze comes when the short build-up is greater than 65-70%, especially when this build-up goes more than 80% on one of the sides. Reversals of the markets have been seen 9 out of the 11 times I have seen this data over the last 2.5 years. So it's a very good lead indicator to what kind of short covering or long covering can come because of this kind of build up on one side. That's point one. Point two, if you look at how the general elections were poised, we've always been saying the first 6 months to the general election, there was a run up expected, but the run up got advanced because of state elections. I think this is as things unfold, there is going to be more and more clarity that the government continuance is a larger probability, and that's what is reflected. That's point two. Point three, if you look at expiry behaviors over the last 6 expiries, you are seeing sharper moves on expiries because there's a lot of algorithmic trading which is using AI to create induced volatility, which is a subject for another day, but that's the most important discovery for a retail participant. There is induced volatility, which AI is able to do today for institutional and hedge fund managers.
Interesting. So you were not alarmed by the VIX about 22 kind of mark in the recent times. You were not alarmed by that, or did not worry you?
Not at all. Actually, if you look at the past, I was very, very surprised that general elections volatility was not being factored in at all. If you look at the June options, if I remember right, I was trading a 22,000 June option way back in February at walls of 14 and a half. 30th the June expiry, which I think is the 27th of June, in a period where it encompasses general election, a 14-15 wall was ridiculously unfair. Any institutional investor would just be a buyer of that option and play the volatility and do a Vega trade. So point one I'm making is 22 weeks for the June expiry is something very, very normal. When you have an event like this, I wouldn't be surprised if there's a 30 wall also. If you look at how 10 days before the election results, general election results, what are the near month futures, which is what in India VIX is all about, 1 month implied options, which in our case now is June 27th, is what is the implied volatility. And I would say that this is still low. If you're looking at a general election, and if there is 1 day of a 5% movement in the next maybe 30 working days, which is what is 27th June, I would say this wall would be breached in reality, as against the realized wall could be greater than the implied wall at 21.
Feroze, what is your positioning in the market if one were to look beyond the near term? If we rally so hard and going into the elections and the outcome actually comes in exactly how the market is expecting continuity, do you see some more scope for rally from here on, or would there be a profit booking?
I think there is a large scope for movement upwards. If you look at how the FIIs have shaped up over the last 1.5 months, they are 8,600 crore rupees negative in the cash market, which implies that they have not pumped in the money. So their conviction that the government will continue is not as high, which is what is shown in the 45 days. If somebody has not been bullish over the last 45 days, he or she or an institution would be waiting for the result to come. If the result were to be status quo government, I think the flows will come back from the FII side. The domestic guys have pumped in 44,000 crores because they have a non-discretionary equity mandate. They invest in equity irrespective because of the kind of collections from the retail participation in the SIP book. which is happening in India. So point one, I would expect a larger rally by which I mean not 10, 20, 30%, which could have happened if the rally was not before the election results, since the rally has happened before the election results. If the outcome is favorable, or the capital market choice is, of course, the continuation of the same government, if that were to happen, I think the rally is intact and further movements upwards are possible. Second point is the earnings growth have not disappointed at all. The earnings growth have been 11, 12% for last year. If you look at how Nifty earnings have moved over the last 4 years, and we had called out this earnings growth much before, when people were in the peak of the pandemic, people were just so pessimistic. In August 2020, we called out that the Nifty earnings are going to go up. So where they went up from 535 to 777 to 821 to 967, 970 to the next year, we expect 1100. So earnings have doubled in the 5-year fiscal, which I think is a great 5-year earnings cycle. And I think market will move its mood from the event to the fundamentals, and there is good news on the fundamentals as well.
Feroze, how comfortable are you on the market valuations right now? And also you interact with some of the most influential investors among the HNIs and super HNIs at Anurati Wealth. Talk to us about, are people still having cash on the side? Are people or big investors approaching this event fully invested? What is the positioning?
I think unlike most other events of this kind of magnitude, HNI this time is far more bullish and far more complacent with the outcome, which is good or sometimes not very good. But to answer your point in question, they're going with very little cash. People are allocating more money before than after, and that's what flows tell me, both for Anand Rathi and for the industry.
That's interesting to know. So people are going into it pretty loaded. That is something interesting. What about valuations, especially mid cap, small cap, large cap valuation picture compared to what the earnings are actually coming out? Are you comfortable?
I see what happens is in the large cap category, I would say valuations, long-term valuations, we are comfortable, not short-term valuations. Maybe Nifty will catch up, maybe 1-2p extra. I think 10% extra valuation is not something which perturbs us too much. I think 4-5% froth in the market on the Nifty side exists. In the mid-cap size, there's more froth, almost about 18-20% of froth, by which I mean the difference between the fundamental level as per us, whatever it's worth, is subtracted from the actual market value. So point two, mid cap has more froth. But I think from mid cap and small cap standpoint, there is a huge pocket of overvaluation and undervaluation as well. So I think because there are 250 stocks in the small cap index, painting them in the same brush, which quite a few market participants do, I think is unfair. Like if you look at the mid cap 150 stocks, there's one stock with 630p, and there's another stock with about 11p. Now that's the kind of variety in terms of valuations on a fundamental, most conventional used valuation parameter of P. So point, I'm not too worried about valuations on the large cap, little worried on the mid cap. Small cap, I think there is huge potential in small stocks because of the variety it has. 250 stocks, there are some huge pockets of undervaluation, is a contrarian point which I'm making. And since money is coming into that space and free floats are low, re-ratings are possible.
Feroze, before I let you go, just want to understand what are the areas which you like for the next 1 to 3 year kind of a time frame which you're recommending your clients?
I think 1 year, I like financial services. Because last 3 years, it has not delivered its long-term average. I think a country like ours, financial services have done a lot of cleanup post-COVID. I think the impact of that is still not fully felt in the valuations. So point one, 1 to 2 years, I would like financial services. Rail and highway for 3 years, 2.5, 3 years. And for the really long term, like 5 years, I would say renewable energy is one sector I would bet a lot of money on.
Right. All right, Feroze, we'll let you go on that one. Thanks so much for joining us on the show today.
Thank you, sir.
We'll take a short break on that note. When we come.
If you like this video, then like, share and subscribe to ET Now.